talk to you. This video is more of a warning, something that I researched a few years ago, about a year and a half ago, before I was driven, out of Idaho and away from my home and so forth. And it's answering the question of what is bank bail-in, and it's extremely important if you have money in the bank, especially if you have a significant amount of money in the bank because, and I'm just going to go through it, bear with me. It's more of a warning. I just feel a urgency to inform you about the change in banking after the 2008 crash, housing crash, and what Obama did and, the Congress and basically our federal government did into the banking industry and how it affects you. Especially if you have any type of amount in your savings. So basically, quickly, 2008 housing crash, the federal government, Fannie Mae and Freddie Mac were borrowing money to anybody, really anybody, to buy a house. And, these people should have never been receiving this money. Because they were never going to be able to pay the loans back. And ultimately that culminated in 2008 and the bank started failing and it was a major housing crash. There was a housing bubble, the cost of housing, the loans on housing and so forth. Well, so the bankers went to work and decided how they can protect themselves from this and keep it from happening in the future. And I'm not going to get into conspiracies or anything like that because that's not what this video is about. And I don't have evidence of that. And I don't like spouting conspiracies without at least some, strong circumstantial evidence. So ultimately what was decided was that the banks were going to protect themselves and use Congress and President Obama was part of this to protect themselves, and so they changed it. They changed the way that you deposit your money, and this is what's so important. They made it so that the money in the bank, when you put your money in the bank, it's no longer your money. And I'm just getting right to the point here because I don't want to get into a lot of detail. When you put your money into the bank, they made it so it's no longer your money. Before, when you put money in the bank, it was your money and they were taking care of it. They were protecting it. They were making it easy and, liquidatable so you can access it. It was easy to transfer and so forth. But now when you put money in a bank, it is no longer your money. You are considered an unsecured creditor, meaning you are. Can you hear me? I'm going to walk around a little bit. For some reason, it's very interesting. I'm losing connection. Will you give me a thumbs up if you can hear me, those out there? I just want to make sure that I get this message out. Yeah, give me a thumbs up if you can hear me. Let's see. Yeah, there we go. Okay, Buzz, thank you. Okay, it sounds like you guys can hear me again. I don't know why that happens, but it does. It seems like it happens a lot to me. But anyway, so where we're at, this is extremely important because after the whole reaffirmation of the banking system after the 2008 housing crash, when you put your money in the bank, it's no longer yours. You are loaning that to the bank. That's the way they're considering it. And you are an unsecured creditor. And that money is no longer yours. Yeah, they keep record of it and you can take it back. And then when you take the money back, it's like them giving you a payment back. And that's what they call the bank bail-in. Rather than a bailout. Remember they bailed all the banks out? Well, they turned it around to where now it's a bail-in. And they did that so that if there was ever a problem in banking again where they overextended themselves and they could not pay all the loans, that they would have all your deposits, your money that they say you loaned to them. They would have that, and it's unsecured, and they don't have to pay it back to you. So that way, if they have all these loans out there and those loans fail, they can cover themselves with the deposits that you put in your bank account, because it's not your money. And that's what they call a bail-in. And it's extremely dangerous for those who keep a lot of money in the bank, or even a little bit of money, because it's not they do not consider it your money. They consider it a loan to them, and you're an unsecured creditor, meaning you don't have any way to, you don't have any collateral. And that's how the banking changed after the 2008 housing crash. And so with the volatility of what is happening, my suggestion is that you don't keep a lot of money in the bank. If you have reserves, I just wouldn't keep a lot of it in the bank. You're better to either pull it out as cash, which, there's insecurities in that too, but it's better than actually holding it in the bank, because it's unsecured. And we saw some banks crash a couple years ago, or they became insolvent. And what happened to those the people's accounts that deposited money? They took that money and they never paid it back because it was unsecured. And so I guess my message here, my warning, is that understand how the banking works now, what changed, and make sure that you don't keep a lot of money in the bank. And I know that that's difficult. Sorry, there's a helicopter flying by. And I don't think they're after me. That's good. Anyway, make sure that I know that's difficult, because banking is here for two reasons. One is to secure our money, and two, to make it convenient to transfer. And but I'm telling you that the security that we think we have in these banks is not there, because they're saying that it is not our money. And that was a congressional thing that Obama did. And so be aware of that. I could go into a lot more detail, and it seemed like there was something else I was going to add to it, but that was the main thing I wanted to share with you, and get that out there. Make sure people understand what the bank bail-in is, and how your money, when you deposit in the bank, is no longer your money. You are considered a creditor that loans it to the bank, and therefore, if the bank ever fails, and you're an unsecured creditor, the bank does not have to pay you back for using your money how they decide they want to, because you loaned it to them. And that's the difference. Before 2008, all the adjustments and things they did, you owned your money. It was your money in a bank account, and now it's their money, and you're just an unsecured creditor. So beware.